Welcome back to Smart Stock Sam, where we cut through the noise, skip the hype, and hand you the kind of institutional grade analysis that Wall Street would rather keep to itself. I'm Sam, and if you're new here, hit subscribe right now, because what I'm about to break down is exactly the kind of setup that separates disciplined investors from the ones left holding the bag. Quick question before we dive in. What if I told you that a company personally anointed by NVIDIA's Jensen Huang as the next trillion-dollar force in semiconductors just handed Wall Street one of the most brutal wealth transfers we've seen all year? What if I told you that the very stock that gained over 225% year-to-date, riding the AI wave like nothing we've ever seen, is right now bleeding out in freefall, and retail traders everywhere are screaming that the artificial intelligence bubble has finally catastrophically popped? That stock is Marvell Technology, ticker symbol MRVL. And here's what everyone is getting completely wrong about it. Today, we're going to rip apart the raw price action, go deep into the insider trading logs, decode what the options chain is quietly signaling, and by the end of this video, you'll know exactly what the smart money is doing right now, and which price levels to watch this week to potentially turn this chaos into an opportunity. Let's get into it. To understand where Marvell is headed, you have to first face the wreckage head-on. As of June 26, 2026, Marvell closed at $266.77, bleeding out over 5%, or $14.49 in a single trading session. One day. Now that alone sounds bad, but here's where it gets truly staggering. Rewind just 8 days to June 18th. On that single day, Marvell hit a peak of $329.88 on an absolutely astronomical 250 million shares traded. That volume is not normal. That is roughly 4 to 5 times its average daily trading volume. It was pure, uncut euphoria. And then, almost immediately, the trapdoor opened. A rapid, relentless sequence of lower highs and lower lows. In just over a week, Marvell torched approximately $60 per share in market value. The company did announce a modest cash dividend of 6 cents per share, with an ex-dividend date of July 10th. But let's be perfectly honest here. Nobody is piling into an ultra-volatile semiconductor stock at these prices for a 6-cent dividend. Investors are here for explosive, asymmetric growth. So what on earth triggered a reversal this violent, this fast? To answer that, you have to understand one of the oldest institutional trading games Wall Street has ever run. On June 22nd, Marvell was officially added to the S&P 500 index. Now, on the surface, that sounds like a gold medal moment. And in a vacuum, it genuinely is. When a stock joins the S&P 500, every passive index fund, every ETF, and every mutual fund that tracks that benchmark is legally required, mandated, to go out and purchase shares of that company. They have zero discretion. It is mechanical, forced buying. And the hedge funds knew it was coming. Weeks before the inclusion date, momentum traders and institutional desks were aggressively front-running the event, quietly accumulating millions of shares, artificially inflating the price all the way up to that $329 peak. This is the textbook buy the rumor phase. And then, the moment those index funds finished their mandatory mechanical purchases on inclusion day, those same hedge funds and momentum traders flipped the switch and started unloading their positions to lock in profit. Millions of shares hit the market simultaneously. The buying pressure evaporated literally overnight. And the retail investors who bought in during the final stage of that euphoria frenzy, they were left holding the bag as the stock cratered beneath them. This isn't a conspiracy. This is the S&P inclusion trade working exactly as it was designed to work. The institutional players write the rules, and they play them perfectly every single time. But here's where it gets really unsettling, because while retail investors were left stunned and confused, wondering what just happened, the company's own top financial executives were already heading for the exits. And when insiders sell, you listen. There is an old saying in finance: insiders might buy a stock for many reasons: optimism, loyalty, confidence. But they only ever sell for one: right at the absolute peak of the S&P 500 inclusion frenzy. Marvell's outgoing chief financial officer, Willem Meintjes, filed to liquidate roughly 48% of his direct equity holdings. We are talking about over 207,000 shares valued at nearly $60,100,000. Let that land for a second. Nearly $60 million in personal stock, sold near all-time highs. That is not a routine portfolio rebalancing. That is a calculated offloading of personal risk at what he clearly considered a peak price. And as if that wasn't enough of a signal, the incoming chief financial officer, Daniel Dern, the man who is about to take the keys to the entire financial operation, also sold shares, unloading over $630,000 worth of stock on June 23rd. When both the outgoing and incoming CFOs, the two people on the planet who understand this company's balance sheet more intimately than anyone else, both decide to cash out near all-time highs within days of each other, that sends a chilling message. It suggests that at these valuations, even the insiders believe the stock has meaningfully outpaced the underlying business fundamentals, and the market heard that message loud and clear. So now you might be asking, does this insider exodus mean the core business is fundamentally broken? Does it mean Marvell is finished? And this is where the story takes a very sharp, very important turn, because if you zoom out and look at the actual financial performance, a completely different picture emerges. In their Q1 fiscal year 2027 earnings report, Marvell posted record revenue of $2,418 million, a staggering 28% jump year over year that absolutely crushed analyst estimates. But the headline number isn't even the most important part. Their data center segment alone generated $1,830 million, representing a massive 76% of total company revenue. This isn't diversified tech growth. This is pure, concentrated, high-octane exposure to the artificial intelligence infrastructure boom. Here's why that matters so much. While NVIDIA sells the massively expensive GPUs that train AI models, Marvell builds the critical connective infrastructure that allows thousands of those GPUs to actually communicate with each other at scale without choking on bottlenecks. Think of NVIDIA as the engine and Marvell as the nervous system threading everything together. That's why Jensen Huang singled them out. On top of that, Marvell generated a record $638,800,000 in free cash flow. The underlying business is, by every objective measure, a cash-generating machine operating at the highest level it ever has. The fundamentals are not the problem. The problem is the price tag, and this is where things get genuinely dangerous. Marvell is currently trading at a trailing price-to-earnings ratio of approximately 91.67 times, a forward PE in the mid-70s. When you buy a stock at a 90 times multiple, you are not paying for what the company is doing today. You are paying for 5 years of absolute, unwavering perfection. Zero macroeconomic shocks, zero supply chain disruptions, zero execution errors. Not one bad quarter is tolerable at 90 times earnings. And right now, the broader semiconductor macro environment is showing real stress fractures. Memory costs are rising and squeezing margins for consumer hardware, which is a key reason Apple recently raised prices on its Mac and iPad lineup. Reports also suggest SK Hynix may be pulling back on high-bandwidth memory expansion. If the global AI infrastructure build-out cools even slightly, and what are the odds it runs perfectly forever without a single hiccup? Stocks priced at 90 times earnings are always the first ones to get absolutely decimated. That is the trap hiding inside even the best companies in the world. However, and I need you to pay very close attention here before you walk away convinced that Marvell is simply an overvalued bubble waiting to fully deflate, there is a structural dynamic buried deep inside their business model that most retail traders and most YouTube finance channels completely miss. And it fundamentally changes the long-term narrative. Marvell's custom ASIC business, the custom chip design work they do for the largest cloud providers on the planet, operates on a massive, built-in time delay, When Marvell wins a design contract to engineer a custom processing chip for a hyperscaler like Amazon or Google, it takes anywhere from 12 to 24 months before that chip enters mass production and begins generating meaningful revenue. That means the extraordinary $1,830 million in data center revenue they just reported. That is the result of design wins that were signed and sealed 2 years ago. The contracts they are closing today, the deals being negotiated right now in 2026, won't even appear on the income statement until fiscal year 2028. This creates what amounts to an ironclad, pre-committed revenue floor for the future that simply cannot be canceled overnight. The pipeline is already locked in. And there's one more card Marvell is quietly playing. They are currently in advanced discussions with Taiwan Semiconductor Manufacturing Company to secure production capacity on the cutting-edge 1.4 nanometer A14 process node. If Marvell locks that down, it secures a decisive energy efficiency advantage over their most formidable rival, Broadcom. In the AI data center world, power consumption is not a secondary concern. It is rapidly becoming the single biggest operational constraint facing every major hyperscaler on the planet. The company that solves for energy efficiency at scale wins the next decade of AI infrastructure spending. And solving power bottlenecks is precisely what Marvell does best. So, we have an extraordinary long-term business caught inside a brutal short-term technical sell-off. That dichotomy is the entire opportunity, if you know how to navigate it. Let's look at what the smart money is actually doing right now. When you pull up the institutional ownership data, the conviction is staggering. 87.09% of Marvell's total outstanding shares are held by major institutional investors, hedge funds, pension funds, and asset managers like Vanguard and BlackRock. Over 1,500 institutional owners holding nearly 762 million shares. The smart money has not lost faith in the long-term AI thesis. They are not abandoning ship. But because the float is so tightly controlled by algorithmic trading desks and institutional managers, when they trim positions and take profits, exactly as they did after the S&P 500 inclusion, the downside velocity becomes absolutely savage. The stock drops fast and hard because there simply aren't enough retail buyers to absorb the volume of shares being liquidated at once. That's the double-edged sword of being an institutionally dominated stock. And if we look at what the options market is signaling right now, the fear is practically screaming off the screen. The put-to-call volume ratio is sitting at a staggering 2.56. That means for every single person placing a bet that this stock will recover, more than 2.5 people are actively betting it is going to fall further. We are seeing over 65,000 put options traded versus only 25,000 calls. Implied volatility, which measures how violently the market expects the stock to move, is running at 103.63%. The derivatives market is pricing in absolute, full-scale chaos. But here's the hidden intelligence embedded in that same data. When you look closely at the concentration of open interest, there is a massive wall of put contracts clustered at the $250 and the $265 strike prices. And here's why that matters more than almost anything else right now. Market makers, the institutional desks that actually sell those put options, are required to hedge their own exposure as the stock declines. As Marvell approaches that $250 level, those market makers will almost certainly begin buying shares in the open market to neutralize their risk and prevent a catastrophic payout on those contracts. This creates what traders call a mechanical support floor, a level where structural buying pressure is virtually guaranteed to show up, almost regardless of sentiment. Now let's put the technical picture on the table, strip away the narrative, and look purely at the price structure. The short-term setup is unambiguously broken. Marvell is trading well below its 5-day moving average and well below its 50-day simple moving average, which sits at $287.39. The MACD has crossed firmly into bearish territory. Short-term momentum is dead. The 14-day relative strength index has dropped to 40.73. rapidly approaching oversold territory. However, and this is the critical variable, the long-term primary uptrend is still completely intact. Because despite all this carnage, Marvell is still trading above its 200-day simple moving average, which currently sits at $252.11. As long as that level holds on a closing basis, the long-term bull case remains structurally valid. The moment it breaks, everything changes. Which brings us to the part of this video you've been waiting for, the actual trade setup for the week of June 29th through July 3rd. Let me be direct with you. Walking into the current market price of $266 right now is essentially trying to catch a falling knife with your bare hands. Downward momentum is still in full force, and there is no confirmed reversal signal. The disciplined play is to let the stock come to you. The high confluence support zone we're watching is between $252 and $255. Why is that level so significant? Because that is exactly where the 200-day moving average intersects with the mechanical market maker defense wall anchored at the $250 put strike. It is a dual-layer structural floor, two independent forces converging at the same price point. If you are an equity trader, setting limit buy orders near that $252 level gives you an exceptional risk-to-reward entry for a technical bounce with a clearly defined invalidation point. If you are an options trader, you can actually weaponize that insanely elevated 103% implied volatility in your favor by selling cash-secured, out-of-the-money put contracts at the $250 strike. You collect a substantial premium up front to essentially get paid to wait at a price level you already want to own the stock at anyway. Your first upside resistance target on a confirmed bounce is $287.39, a return to the 50-day simple moving average. That's your initial profit target, and your hard, non-negotiable stop loss is a confirmed daily close below $239. If Marvell closes beneath $240, that invalidates the 200-day moving average support, it breaks through the options defense wall, and it signals a deep fundamental valuation reset is underway, not just a technical shakeout. If that level breaks, you exit without hesitation and wait for the dust to settle before reconsidering. Now, before we wrap this up, there is something important I need to say. Everything discussed in this video is purely for educational and informational purposes only. Nothing here constitutes personalized financial advice, and I am not a licensed financial advisor or investment professional. Trading and investing in individual stocks involves significant risk, including the potential loss of your entire invested capital. Marvell Technology is a high-volatility security, and the scenarios discussed here may not unfold as analyzed. Always do your own due diligence, consult with a qualified financial professional before making any investment decisions, and never risk more capital than you can genuinely afford to lose. Past performance, whether of a stock or an analysis, is never a guarantee of future results. So where does that leave us on Marvell? Here is the honest, unfiltered verdict. Marvell Technology is without question one of the premier foundational assets in the global artificial intelligence infrastructure race. Their custom ASIC pipeline, their optical DSP technology, and their positioning inside the hyperscaler supply chain are practically unrivaled. The business is generating record cash flow, and the forward revenue floor built from today's design wins is already locked in. But the stock right now, is digesting a deeply toxic cocktail of extreme valuation multiples, post-S and P inclusion exhaustion, and high-profile insider selling at peak prices. It is a fantastic company that simply got priced for a reality that hasn't arrived yet. Great companies and great stocks are not the same thing, and right now, the price is the problem. For the long-term investor, this pullback is exactly the healthy, painful consolidation you want to see, the kind that shakes out the over-leveraged momentum chasers and resets the chart for a more sustainable move higher. For the short-term trader, you must be nearly robotic in your discipline. Do not step in front of falling momentum. Wait for the stock to reach those high confluence support levels we've mapped out. Let the market maker mechanics do the heavy lifting, and always, always protect your downside with a firm stop loss. Now here's my question for you in the comments, and I genuinely want to hear your thinking on this. Given everything we've just unpacked, do you think Marvell's 200-day moving average holds as a floor, or do you believe the insider selling is signaling something deeper that the market hasn't priced in yet? Drop your analysis down below. I read every single comment, and I personally respond to as many as I can. If this kind of deep dive breakdown added real value to your thinking today, do me one favor, hit the like button. It genuinely helps the algorithm surface this analysis to other investors who need to see it, and it only takes 1 second. And if you're not subscribed yet, hit subscribe and ring the bell right now, because I put out institutional level breakdowns like this one regularly, and you don't want to miss the next setup before it moves. And here's something worth knowing. I've launched the Smart Stock Sam membership community, and it is already active. Members get early access to trade setups before I publish them publicly, priority replies to their questions, and the ability to request custom analysis directly from me on stocks they're personally watching. If you're serious about leveling up your investing or trading, not just watching videos, but actually implementing a disciplined process, the membership is built exactly for you. You can join directly through the link in the description below. And if you want to go even further in supporting this channel so we can keep producing research like this, YouTube's Super Thanks feature is right there under the video. Every bit of support makes a real difference in what we're able to build here together. Stay disciplined, protect your downside, and I will see you in the next breakdown.